Well, good evening, everybody, and welcome to the May edition of the Roundtable. This is kind of a follow-up to one that we had done face-to-face in Cincinnati, Ohio during the NAIC Better Investing National Convention just a couple of weeks ago. We are going to repeat parts of that program, clean up a couple parts of the program, and share a little bit more information. But most importantly, we have a little bit more time. We had to squeeze it into 50 minutes down there. Here we can go just over an hour, and that is what we try to do. My name is Mark Robertson. I am founding partner and manager of Manifest Investing. And I'm joined here tonight by three other knights and damsels of the round table, starting with Kim Butcher. Kim is a national presenter at the conventions and meetings around the country, and she's a volunteer educator. She hails from Evansville, Indiana, and she's currently down in Florida visiting her parents. Welcome, Kim. Cy Lynch also is been doing this for quite some time, though you guys are very familiar with him. He's got a very storied background, of a staunch Atlanta Braves fan, but most of all, he's been an investor for quite some time, going back into, what, Cy, the 1980s?
Yes,
Or even before.
84 was my first stock purchase.
I believe Cy was involved in the IPO of Home Depot, so that should give you something to benchmark by. So welcome, Cy. And last but not least, our dear friend Ken Cavola. I just want to take a moment and again tip my hat to Ken. He was honored at the National Convention with the George Nicholson Lifetime Achievement Award for his efforts for, again, multiple decades in helping people learn how to do this stuff. And we're stone cold serious about, we believe it works, and we will take the time to show people how to do this. That is what tonight is all about. It's what these programs are always about. Just this power of demonstration, and Ken is just a landmark example of how to get this stuff done right. So again, we take our hat off and give you the cyber applause of an internet standing ovation, Ken.
Well, thank you, Mark. It's so appreciated, and I'm humbled by the number of folks that continue to see our mission as important. And as long as we have people to teach, I think that you and Cy and Kim and myself and Hugh and the rest of our damsels and knights, I think we'll be pursuing that mission as long as we have people that we can teach.
Yep, it can make such a strong difference, and again, thank you. Just a quick note here, the housekeeping, no investment recommendation is intended whatsoever here tonight. We do try to demonstrate, as we say on the cover slide, it is all about demonstration, illustration, education. And I think one of the more powerful ways to do that is to actually lay out case studies and things that people can sink their teeth into and are actually participating and studying alongside with us. You learn by doing. We know that, and that really is what we're here to do, to demonstrate these philosophies and these methods of the modern investment club movement. We may hold a few of these stocks in our portfolio. We try to mention it when we do, but again, the most important thing is this is about education. Please don't use anything as a recommendation, and please do your own homework. Here's a quick look at what our standing agenda generally looks like. We are coming up on our 7th anniversary of doing this, so 7 years of these programs. As we were saying in the pre-session, you can find a number of the recordings on youtube.com. If you search Manifest Investing and Roundtable, just those words, you will find the collection on the page that YouTube stores all the monthly series. And you can go back and take a look at previous presentations. This is kind of the standing agenda. We will give you a little background about what this is about. We do keep track, we do keep score, and we do examine our results. We do have at least one challenge and a couple others that we're going to talk about in this mode of selling and perhaps doing a little bit of late spring cleaning. And then you can see the 4 tickers that are going to be presented tonight as companies: Dollar General, LGI Homes, StarBucks, and CVS Health. We do hold a poll at the end, even if you're joining us for the first time. And by the way, an extra big hug and a welcome if you are joining us for the first time. You're invited to participate in the audience poll. And as Ken was saying before the session, you can raise your hand. We will take a moment to explore things as we go. We do try to keep this informal, but be reminded there is a open Q&A session at the end, and we typically do try to empty the queue of any questions and give people stuff to chew on and homework assignments, that sort of thing. Just a quick summary of what we've been doing. Every month, and lately it's been the last Tuesday of every month at 8:30 Eastern Time, 3 or 4 or 5 of us come together and talk about a single favorite analysis opportunity. In other words, a study opportunity that we believe is well positioned to have a pretty good outlook going forward. And we pick the stocks, we keep score. Our long-term goal is for the collective results of the decisions that we make to beat the market by 5 percentage points, or 500 basis points if you speak that language. We do benchmark against the Wilshire 5000. We do like to see the majority of our stocks outperform the Wilshire 5000 from the time of selection during their individual holding periods. Here's a look at our results over time. What you are looking at is, again, approaching 7 years, where we take a look at the actual performance of the portfolio and compare it versus what would have been achieved if we've just blindly invested into the Wilshire 5000 total stock market index. The difference is known as the relative return. Our goal here as a community is to try to beat that. In other words, generate a positive market-beating performance, and our target is generally 5%. Beat the market by 5%. We're going to be able to get there. So you can see that we've been chugging along at about 13%, a couple percentage points better than the market, and with approximately 50% of the selections, at 47.6, beating the market on a stock-by-stock or a decision-by-decision basis. Any comments or questions from anybody?
No, we're clear, Mark. We can keep going.
Okay, we need to keep rolling because we're going to hit that selling stuff pretty hard here tonight. Here's a look at the portfolio. It's actually the one as of a couple weeks ago. I didn't update it for tonight. It's not dramatically different tonight, a little bit bigger. But what you're looking at here is listed from the largest position down to the 20th position in the portfolio. There's approximately 90 stocks in the portfolio, in the tracking portfolio, that you can look at every single position up at that link up at the top of the page. That is a public link. We won't know you're looking at it. You can actually look at the dashboard as you see it displayed here. Only all 90 of them will be there. And what we do is when a stock is selected by any damsel, knight, or the audience at one of our monthly sessions, we take and invest $1,000 into it. So in the case of Cognizant up at the top, Cognizant's been selected 12 times totally, so $12,000 have been invested. And as you can see here, that $12,000 has now become $20,000. So pretty good bump. I'm sure that Cy, you can take a bow on this one, because I think you're responsible for 9 or 10 of those 12 selections. And
probably 15 of them, but
yeah, 15 considered. Yeah.
We've only made 12, Cy. Come on.
He keeps sneaking in those other ones, EPAM and Infosys, and they come in undercover as Cognizant. Well, anyhow, down at the bottom, you can actually see the number of times a number of the companies have been selected. You see Cognizant 12X. Apple has been selected 8 times. That's why you see the parentheses up there. So we just kind of stuck a few of them up there so that you could see. CVS is the company I'm bringing. It's been selected 6 times. That $6,000 is now worth $6,700. And you can see a number of positions. The ones that Ken likes to point at is the ones that show up on this largest position list that have a single time selection, like NetEase down at the bottom. Go ahead, Ken. Brag about it now.
Well, I love NetEase, and I wish that we would have chosen it, as many times as we chose Cognizant. I'm focusing on Mesa Labs, Mark, because since you printed this, and this is about a week and a half, 2 weeks old because it was prepared for convention, since you printed it, that Mesa Labs quote there is up in the mid-140s now, or at least it was this afternoon sometime. So Mesa's just taken off, roaring yet again, and has done a wonderful job. We've only chosen this one 6 times, and it's worth $12,000 now. So we put in $6,000, and that price is off by about $12 or $14 now.
It's actually $156 tonight, Ken.
156. Well, all right. So it's just chugging right along, and I am so glad that it sits in two of my portfolios. I am so happy to have this small, really fast grower, and I didn't have to sacrifice any quality of any kind. I didn't have to sacrifice history or anything to find this particular company. So it's performing just wonderfully.
Anything jump off the chart at you, Kim? Or Cy?
I think we've pretty much hit it. Probably the one, and I don't know what lesson can be learned other than a question mark, I guess, whether there was stubbornness, because I think I even have a pick on it. I think most of us do, but I see Qualcomm is 8 times, and notice it's sitting there at about $8,000, so it hasn't done a whole lot as a whole.
Yeah, and it's actually been languished so long and maybe solved some of those challenges that it may be coming back into a
right
better position these days.
Yeah.
Any personal favorites on there, Kim? Did we lose Kim? Hope not.
No, I was going to talk about S&P Global. When I presented that, it was like at $83, and it pulled back to ultimately $79, and I presented it once, and then the following month I think I presented again, and the audience agreed with me, and I'm just kind of like bunching for joy. It closed at $140, over $140. So from, I think, 83 to 140, I'm not complaining.
Yeah, she's actually giving us a nice segue to our selling discussion, and Ken and I gave a discussion on selling better ? At the national convention, and Ken's position in the whole thing was to reinforce that we're not talking about taking anything away or doing anything different than the traditional stuff. Ken, would you like to spend just a moment describing your discoveries here?
Well, you know, the traditional stuff works for me. It always has worked for me, and I don't want to abandon any of that selling discipline that I've developed over so many years. I know that my basic selling philosophy comes really, really close to what you believe fundamentally at the bottom of the process, and I know that it's what Cy and Kim believe as well. I went way back to the 1984 investing manual where it said 90% of all sales basically are going to be based on Rule 1, and when I looked up Rule 1, it was written in a little bit obtuse language, but basically Rule 1 was you sell when you can make the portfolio better. So I'm looking at stocks right now that have par values down near the bottom of the list. These are par values just like you get off of your own SSG when you do a stock selection guide. And these par values are indicating there's not much growth left. You know, when the price moves up dramatically, like Kim just mentioned about S&P Global, then a lot of times the potential for the stock moves in the opposite direction. Usually a stock with no real fundamental problems, as the price goes up, the potential for the future goes down, and sometimes the market's just handing you a pile of cash and urging you to take that pile of cash and reinvest it in something with more potential. In other words, make the portfolio better. So I see we have Coach at the very bottom of the par list, followed by S&P Global, Deere, Novo Nordisk, and Waste Connections. And I would ask myself, are any of these non-core holdings? Are any of these stocks that I don't plan on holding, you know, over the next 10, 15, 20 years? And if they're not, this might be an opportunity to sell them and bring a little bit of profit into the portfolio. I'm looking at Coach, for example, and I know Coach has had a real rough time of it, but recently it's begun to recover, and as it's recovered, even though its growth numbers are still fairly small, the sales growth right in the middle of the chart, the sales growth is only 2.6%. We know from our portfolio averages, I'm looking at them at the bottom there, that our growth is a little bit slow for this tracking portfolio. We'd like to see it up around 11.5%, and it's only 9.6%. So selling something that's a slow grower with very little potential going forward is going to do the portfolio a service. Now, the growth in the next couple is not nearly as low, but I would at least move to put on the table that we freeze our position. That's the way we talk about selling something out of this tracking portfolio, and that we freeze our position. If we have more than one, freeze all of them in Coach. So I'll put that on there for discussion.
Okay, well, we can take a closer look at Coach. Again, with that, the challenges I've always interpreted it based on Nicholson's teachings, speaking of George Nicholson, Coach has the weakest return forecast, even if you give it slightly more ambitious assumptions. And let's take a quick look at that. And by the way, the portfolio could use a little bit of a boost on the par side. Well, it's sitting there at 9.8. Go ahead, Cy.
Yeah, I was just going to say that, and I realize that the core non-core distinction becomes particularly important when you get beyond Rule 1. So I understand that's part of why I'm sure Ken mentioned it. Mm-hmm. But when I'm sitting here looking at a par for a portfolio, and again, this is a tracking portfolio, not a completely fully managed portfolio, but we seek to manage things like growth and par like it was a managed portfolio that is 2 points. We're only 3 points above par, or above my par. I think it needs, if this were a a managed portfolio, it would need some heavy selling looking, regardless of whether you were looking at core or non-core holdings.
And I absolutely agree, Cy. Absolutely. Yeah.
Mm-hmm. So I think Coach is at least on the table. S&P Global could be on the table, but I think it might be an opportunity to wait for them to demonstrate some stuff. And we'll be talking about Noble in a different context. Waste Connections, I believe that's a one-time selection, folks, for one time, so $1,000 is now $3,500, and that could be an example of you just celebrate, take the money and run in some cases when the return forecasts get this low. Here's a longer-term look at Coach using our Chronicle. That's the time series of month-to-month snapshots of the stock price on the green bars. The blue is the quality EKG, and you can see that everybody instinctively knew this was happening, but they have been challenged by the likes of Michael Kors and others. And the red line is, again, no different than a Section 5 output from a stock selection guide on a month-by-month basis. And you can see that the return forecast, despite a drop in the stock price, has actually slumped down into the mid to low single digits. So that's not a good deal. So we do a quick audit. Here's a look at the company. The company is retrenching. You can see that the earnings line is the blue line on the right. Obviously, they're selling some stuff. They're switching their portfolio around, and they've hired key management into several different positions to breathe life back into some of the brands. They have been on a heck of a run from over the last 6 weeks. They have gone from the mid to high 30s up to $46 as of yesterday or tonight. But the margins have been maturing and bottoming out probably at levels they didn't think they would see back in 15 and 16. And the PE has obviously matured into the mid-teens. But we're talking about a situation where even with fairly decent expectations of 5 or 6% top-line growth, robust margins recovering back from where they've been over the last couple of years and are expected to be here in the short term, we're talking about a company even with fairly ambitious projections, somewhere in towards the low end of our return forecasts in the tracking portfolio. Any comments or questions
Mark,
on this, gang?
Yeah, Mark, I want to, when we answer the question that we saved until the end, I think it was from Joe Whitaker, I'd like to come back to this net margin graph and talk about it just a little bit more. Okay. If you can kind of try to remember that.
I'll try to remember that. It's certainly something we're talking about. So I think we can probably give Coach at least a timeout, from a purely traditional challenge standpoint. Anybody opposed to that? Well, hearing none, I think we'll just go ahead and do it. Well, as Cy and Ken have both mentioned, we think you have to put stocks into context. Again, just as you do with other things in life, you have to recognize that the situations are different, and we have to think differently about core versus non-core stocks. One of the things that Ken and I came to the conclusion of as we were studying this relatively better selling, just was this notion that we have to be prepared to treat, think of it as a different size leash on the dog if you want, core companies versus non-core companies. In other words, if it's Johnson & Johnson, it's okay for that return forecast to sag a little bit further than another less or more speculative holding. And this slide is just a reminder. We also came up with the definition there at the top that really a core company is a very high quality company that survived at least one economic recession, bear market, or true test. So it really is a matter of the metal being tested. And I think that's a pretty good definition for most of us in the room when it comes to core versus non-core. Any expansion on that, Ken?
No, I think that the slide does a really nice job of putting it in very simple language, Mark.
Okay, so let's go ahead and press on. Here's what we've kind of come up with, and bear with us, folks. We're going to try to come up with a standard operating procedure that will be a part of all these meetings, only we're going to try to get through it in a pretty straightforward session. But this flow chart does kind of help. What we're talking about doing is for any holding that's in its first year as a holding period, we're gonna look at it and compare versus market performance. And again, this was the stuff that was inspired by Investors Business Daily and that 7 or 8% automatic stop loss. We said, well, we think that's too little, and we also think that it needs to factor in market performance. And we settled on that 20% weaker than the market or less than the market type situation. And then coming down to the first box then, was it a core holding? Because if it's not and it's 20% behind the market in the first year of holding, you just simply walk away, call a timeout, and sell it. So, but if it is a core holding, then you check in and you say, are the return forecast and the quality still okay? If they're not, you sell it. If they are okay, then you say, well, what about the favorable industry comparison? In other words, it might not be doing very well versus the market, but maybe it's doing pretty well considering, powerful influences within its own industry or whatever. I mean, think back to the times when you've looked at a company where it was actually sagging pretty badly compared to the market, but it was doing very well versus its peers or competitors. And I think that's kind of like phone a friend or a lifeline or whatever you want to think about. You hang on to it, but just retain and be very vigilant. We've got a couple examples of how a few of the stocks in the portfolio fit this. Recently, again, taking a look at some of the selections that were made back in July and September, Tractor Supply, Novo, Midnex, these are all lagging the market by greater than 20% since their time of selection. And Mednex is an example of a company that I think is somewhere in the gray area. It's a very high quality company, but it just doesn't fit the same type of core type thinking for me as even Novo on this chart or Johnson & Johnson, fill in the blank. Think of a very high quality core holding that you are familiar with. And Ken and I were kicking this one around a little bit earlier. Here's a look at what we're talking about comparing for some of the companies. And this is Mednex. The Mednex is the green that you see up here at the top. And you can see that we're comparing it first and foremost versus the Wilshire 5000 measured by the mutual fund VTSMX. And you can see that, here's where that drop off in performance begins to take place. In some cases, that will happen in the comparison versus the industry, which is the red line that you see here, will actually be favorable and kind of bail it out. But in this case, we're looking at Mednex has underperformed the stock market in an industry that has actually beaten the stock market since the time of selection. So this is not a terribly favorable position for Mednex. They're clearly not performing very well. They're 25% behind the market as measured by this distance, and then you can tack on another 8% or so for the industry. So they're lagging their own industry by a huge amount, and they're lagging the market. So, you know, is there something else going on there that merits concern, or the type of thing where you'd call a timeout and walk away in that first year of holding, as we kind of learned with some of the stocks that we followed over the last couple of years. So here's
I think one thing that we talked about also, Mark, was that we were kind of impressed with the idea of comparing what we're doing here to the idea of the rule of 5, and understanding that no matter how much you work on a stock selection guide and how detailed your analysis is and how much time you spend reading source material, it still seems to work out that about one stock in every 5 doesn't do what the stock selection guide predicts that it should do. And we're kind of looking for a method to remove those from the portfolio. We'd love for a rule that would help us not buy them in the first place. That was suggested to us in one of our classes at convention. But since we don't have a rule that will help us not buy them, we're looking for something that will help us get them out of the portfolio, at least during the first year. That doesn't mean we might not come back to Mednax 6 months from now or 18 months from now or 2 years from now and decide that things have solved the problems, whatever they might be, and it might be a useful investment again for a time period. That's exactly what you do with non-core holdings on a pretty regular basis, I think.
Yeah, I agree. Great point. And it's something that as we were hashing this stuff around and kicking it around, just this reality, and Ken's right about the frequency. The amount of time that this is happening, it really is not something that happens all the time. But in the roundtable portfolio, you're going to see a half dozen times each year that you're going to have a stock that just doesn't behave well. I mean, think back to my iconic brands. That was an awesome, perfect stock study. The situation, what could possibly have gone wrong after my presentation on how wonderful that was. And, I mean, we watched the bottom fall out of that. So these things are going to happen. And all we're talking about is a system to detect, call it timeout, and scratch your heads, scratch your chins, and make some decisions. So
well, I'll throw one thing out in response to the question of how to avoid buying them, and I throw this out because it's a question I have about testing the methodology. So you can both test it as a potential sell discipline, but if you actually find there are situations like it could potentially become a not buy discipline as well. And that is how often do you run into stocks that appear to be high quality stocks, which truthfully I think Mednax would still fit that definition today, yet has met the criteria if you had, in other words, it's more than 20% relative return off its 52-week high when you are considering it for a buy, should you be buying it? That's my question about this discipline. If it works for stocks we own, then it should also work for stocks that we're considered buying.
That's really an interesting point, Si. That's something that I want to chew on for the next couple of months. That's a really good point.
It actually might even tie into some of Hugh's mechanics of his selecting versus 52-week lows, or some derivative or iteration of that. So anyhow, for tonight, we just thought we would share. We see this as at least one potential prototype for how this can actually take place. What you're looking at is 4 stocks which have qualified either this month or in recent months as a result of that first column. Their relative return, that's how much are they trailing the market. The market is measured by the Wilshire 5000 since the time of selection. You can see that 3 out of the 4 are above, are actually deeper than minus 20. LKK used to be minus 26 or so, and it's actually improved its situation. And then the question core. And again, I left a question mark in there for MD, Mednax, as I'm not sold that it's completely core. And then when it comes to Tractor Supply, it certainly fits the description of a high-quality company that has survived multiple recessions, but I think there are many of us in the room that almost refuse to call any retail stock core, or almost any retail stock a core investment, and this one certainly fits that bill, I think. Any thoughts on that, guys? Is Mednex not a core stock? How about Tractor Supply?
Well, I'm willing to put a question before the four of us, Mark, and I would suggest that we freeze our positions based on the work we've been doing and begin to test our hypothesis, and we freeze our positions on Mednex and Tractor Supply at tonight's roundtable.
So go ahead and sell or freeze those two?
Well, sell it whatever, for those two, right.
Call it sell. Yeah, because look at the chart at the bottom. You're basically looking at Tractor Supply versus the market, which is blue. But look at how it compares versus Lowe's and Home Depot.
Right, and that's, I'm not, well, I think raising the industry question as part of the core, non-core discussion, I think merits, is a good thing that we need to consider, because I would tend to consider most cyclical companies non-core holdings. Not, again, I don't even want to make that a blanket rule, because I think there are cyclical companies that perhaps would fit the definition of core. And I only throw that out to say I'm not uncomfortable. That's terrible. Let's turn it into a positive. I'm very comfortable with questioning Tractor Supply's core holding. I would probably argue with you on Lowe's, Home Depot, and we could name other retail companies, McDonald's in the restaurant retailing. I would probably advocate very strongly those are core holdings, although I also don't object to anybody in the world who says I'm not going to own them or I'm going to not treat them as core in my portfolio. I understand why you would do that.
Mark, I'm going to be a little bit quick to pull the trigger for the next 6 or 8 months on some of these companies, because I would like us to have a database so that when we go to convention in a year's time, we can point to how well our ideas about capital preservation have served us over this time. So I mean, if we come back and Tractor Supply has tripled from where it is right now, then there's probably something wrong with what we're thinking. But if Tractor Supply continues to languish or move even lower, maybe we're onto something.
Well, this one scares me, and the research that we've done, and we'll share a link to the research. So far, we have one exception. Oracle is a company that actually qualified for this treatment a few years ago, and it has recovered and outperformed the market since that time. So that is, we are talking about being vulnerable to that type of a situation, especially if Tractor Supply gets their house in order. One last thing I'll leave this slide with, we put the industry comparison thing in there kind of as a lifeline or a check on the whole situation. And LKQ was a candidate for sale a few months ago. It just didn't feel right. And as we looked at it, it was actually performing very well versus its industry, and we ended up holding it. And I think that may actually pan out to be a nice case study. Here's a look at it over time. You can see that it's had a pretty nice bump up here in the last couple months. And again, the only thing that saved it was this instinct back a couple months ago that, well, geez, it's not doing that bad versus its industry, and its industry is not keeping up with the market. So, maybe we shouldn't be quite as harsh on it. Well, I think the chart that we're looking at will quantify that as we become more accustomed to using it. So, again, that case study within, and Ken's right, I think the more case studies we have probably have merit going forward. So we'll just leave it at that. Go ahead.
Yeah, I have to agree, because as Ken said, the more you do this, the better we're going to get at it, and the more we're going to get more clarity on it. And I'll be the first to admit, I have a bias. I don't have retail stocks in my portfolio. It's a bias, and I'm very simple. The general public can decide you love something or you hate it, and they're too finicky.
Especially with apparel.
Well, and if you can't get consistent with your cash returns, I'm picky. I don't like it. But for me, and I'll admit, NVO is one of my core holdings. I just think the government is choosing to reimburse differently, but human behavior is not going to change. That people are going to eat too much. There's more type 2 diabetes, and they're the #1 manufacturer of insulin in the world. So for me, as being a core, I just reinvest my dividends and just, that's okay.
Well, I thought as we leave the subject and go to our stock presentations, just wanted to reinforce that two-part theme of we're not talking about changing anything. The traditional challenge stuff remains intact. Tonight we decided to sell Coach. The reason we're selling Coach is it has a low return forecast. Also an opportunity to improve the overall growth rate of the portfolio. We'll leave the rest of those 4 and revisit whichever one of them is on the hot seat next month. And in the case of the stuff at the bottom, that's reason number 2, preserving capital in the first year. We're going to go ahead and call Mednax and Tractor Supply either non-core or marginally core, and just look at their track record and just call a timeout for both of them. And again, looking back at so many of the cases that we've looked at, like the iconic brands.
So Mark, just to be clear, if you could go back to that flow chart real quickly. Mednax and Tractor Supply both fall off the flow chart either in the second block down. Is it a core holding? No, sell, because it's fallen more than 20% on relative return. Or if you did decide it was a core, they still fall off down on favorable industry comparison then.
Correct.
So either, whichever way you want to think about it, our analysis at the moment, at least, is telling us to sell these two.
And we'll continue to hold LKQ. And for that matter, Novo, I think you can make the argument that why don't we wait and see if some of the stuff that Kim is talking about begins to materialize. And perhaps the global recession does have something to do with that also. So anyhow, those two things. Go ahead, Ken.
Mark, I'm just going to remind us that we're at about 10 after 9, and if all of us can keep our presentations to 6 or 7 minutes, I think we'll come in roughly where we want to come in then.
Okay. Well, why don't you take us away then, Dollar General?
Okay. Let's see if I can do this in 7 minutes. Okay. I presented Dollar General to the convention roundtable because I think it's a Nicholson triple play. Now that recent price is about 2 weeks old. I would have hoped that you would have bought it at that price rather than the price it's at right now, because it's had a little bit of an uptick in the last week and a half or so, kind of a nice uptick. Yeah, so it's up a couple of dollars, but it's still what I would consider to have a fairly depressed stock price. And the way that I measure that on a value line sheet is I look for double-digit returns at the low end. When I see double-digit returns, to me that's about 1.5 times the market, maybe 1 2/3 times what the market return is. The market average, as measured by Manifest, is somewhere around 7%. As measured by Value Line, somewhere around 6.5, 7%. So I think 11% low estimated return qualifies as a depressed stock price. Then I'm looking for the possibility of the PE ratio to expand, and I look at the top and see a PE ratio of 15.6. And I compare that to Value Line's call 3 to 5 years from now of 17.5. That's PE expansion. And then I'm looking for net margin expansion. The most recent real number on the net margins is 5.2, isn't it? Yeah.
5.3.
5.3, okay. And I'm looking out into the future where it's 6.5 plus. So again, I think I'm seeing net margin expansion, at least in Value Line's opinion. So I'm thinking this might be a triple play. And Nicholson said, put a triple play at the top of your to-study list, because more often than not, they're going to be buys and they're going to be significant gainers in your portfolio if everything falls into place. Next slide, Mark. Up straight and parallel. What more can you ask for in a company? And notice the tick on the I-bar, the most recent I-bar, priced down near the bottom of its range for this particular fiscal year. Next stock, or next slide. I'm looking down at the analysis. I'm seeing fairly decent growth. I'm seeing numbers, and I don't go by that red, green, red kind of stuff. I look at the numbers themselves, and I'm seeing numbers that I think are reasonably decent. I go to the different sources that I use. I find out that Dollar General is the most profitable of the dollar stores per square foot. I found out that they plan to grow by 1,000 stores this year, and they're ahead of schedule as of the middle of April. I find that they're still the largest store of its kind in its niche right now, even after the merger of Dollar Tree with Family Dollar. So I think there's a lot of how will the company grow questions that are being answered in the positive way. I'm looking at a pretty decent dividend for the company. I'm circling what the PE averages are, high and low, and they're certainly within realistic places for a company that might be growing as much as 8 or 9 or 10%. So next slide, Mark. When I do my own SSG, I'm getting a par value of 12.3, a high of 15.6. I like to think of it as a range. You know, somewhere between those two numbers is the return I might get for this company. Next slide, Mark. And here's the Chronicle. I would never buy a company with declining quality, but I'm looking at this company. I'm seeing since 2000, maybe 13, 14, I'm seeing increasing quality. That's the blue line, and you can see it moving up. That to me is pretty decent. On top of that, except for that one spike back about maybe 10 months ago, this company is trading at a par value that's near its all-time historic high for the last 4 or 5 years, and that to me is also something I really like to see when I'm buying a company. One more slide, I think, and then I'm done, Mark. This is the Eagle from Manifest Investing. It's actually a stock selection guide. I think the PE ratio in the analysis that was done in this Eagle might be a little bit low. And it gives a par value a little bit less than the par value my stock selection guide gave. But what's important to me is that they're really in the same ballpark. They're very close to each other. And so I'm getting validation from the Manifest site that my SSG is probably sitting in a pretty good place. And do I have one more slide, Mark? I don't think so. I don't. So I'm offering another position in Dollar General in this portfolio.
All right. Thanks, Ken. With that, we'll switch gears to Kim, who's going to go with LGI Homes.
I challenge myself sometimes to look in industries I would normally not be interested in, and home building was one of them. So as you can see, it is a small cap. It's only been around for about 5 years. It's a very unique model in what they do, as they eliminate the realtor, and they are one of the fastest growing home builders in the nation based on sales. They're one of the best at what they're doing, and their model is completely different because they have the construction firms to keep the price down. They want to get first-time homeowners into a home. They don't have to have any down payment. They get to pick what house they want with the added benefits, and they have their price control so tight. They're building communities so that would have parks. They have walkways in there, maybe a fishing pond, and it's a new model that I'd not seen before because they're eliminating also the realtor out of that. Next slide. One of the things, this just reported in the 1st of May for the first quarter of 2017, net income had increased. Their home closing closed at a decrease of 9.8%, but they have a backlog increased 33.5% to, they've got over 1,000 homes that they need to build. And they're planning, and what they said in the management letter, in the second and the third quarter, they're planning on having more homes closed then. And that has increased every year as they've started. And they actually buy the land, build the community, and build the community around in those areas, Texas, Florida. I'll have a map, next slide, as to where the community's population is growing. So they need more homes. You have more people who want to get out of rent, who want to get into a home. And these are their areas that they're specifically going into. Next slide. They've gotten awards for how their quality is, and they provide a warranty. And as in developing the land and the communities, because of those streamlined awards, like I said, it's much more efficient with cost savings, and that means a lower house price for the people to be able to buy. Next slide. They also have that 0% down option, because once you qualify, they also have some of the financing, and that also makes it better for them. Next slide. They have a warranty on your home to keep it in check. They have a checklist for your the seasonal area and the warranty area. So they're trying to be the all-in-one inclusive area, keeping costs down and keeping customers happy. When you look on their website and the company's website, guess what? Everybody's thrilled with it, because the hard part of getting your first home is getting enough money saved to do it, and they have eliminated that. Next slide. I personally am I think it's very important to find out if management has any skin in the game, and I like to look at the proxy, the 14A, and I like it that this stock, as a small cap, the CEO has to own 5 times his base salary, other executives 3 times, and other executives 1 time. And they give them 5 years to do this, and they have to vest any stock that they get as bonuses. They have to keep it invested for 3 years. So they can't just get the stock and sell it. They've got to keep the stock and keep their skin in the game. Next slide. It's real important for me to look at comparison of the home builders that they're compared against. They compared home builders in the $500 million to $1 billion area, and what they've done is they are growing faster, and they have better profit margins than these others. So that means they're doing it, as Ken talked about, you want increasing profit margins, and they're doing it. The other thing that's really interesting is when you look at this, I have actually looked at peers in comparison, and I have found, like in this stock, these are all home builders. I've also found, I was looking at one specialty chemical company one time, and they had a food company in their comparison. So this stock, the management team and evaluation for executive compensation is looking apples to apples for the comparison, and I like to make sure that's one of my little checklist items I like to check at. Next one. Here's my front of my SSG. It's just starting off, getting to be front up straight and parallel. As Ken said, if you notice the price bars, that is dropping down. Next slide. This is the back of my SSG. If you'll notice, the average price earnings ratio is 11.6. Currently, it's only 9.6. That's one aspect of the triple play. You've got a lower PE, so you've got to expand, so you can have expansion of your PE as the stock price goes up. Next slide. This is the back of my SSG. In being very conservative, I had growth at 15% and earnings per share at 15%. Historically, that's been in the 80 and the 60% range. It gave me a 3.3 to 1 ratio, and because the current price as of last night, this afternoon when I did it at 32.41, it was in the buy range. Next slide. But it's something for you to consider if you want to have anything speculative in your portfolio. I wouldn't have this as a core in mine. I'm considering just getting a few shares because it's a small cap. I don't have enough small cap in my portfolio, and it's something, it would make me have to expand my biases that I have. I recognize with interest rates going up, this could affect this company, but with the backlog that they have and the more closings that they have, that's also going to help their revenues going up and their earnings per share. And because they are the financing agent and they also eliminate the realtor, I think they're going to be able to have control their costs much better. So this is a stock I'm asking everyone to consider.
Well, thanks, Kim. That's another one of the community building concepts that's worked for a few people, and could be very interesting to watch this one unfold as the years go by. All right, we'll go to the other end of the spectrum, and expensive cups of coffee. Take us away, Si.
It all depends on what you buy, Mark. Basic dark roast is actually not all that much more expensive than you would get anywhere else. But all those other things that I never buy at Starbucks, you're right, they're rather expensive. But here is Starbucks. This was my pick at Bink. And as Ken said, you would do even better buying it at the price back at Bink than today's price, because it's up about $4 or $5, not a share. So it's doing well, but as you can see, up straight and parallel. Let's go ahead and go to the next slide. Here, the tack that I decided to take this month in evaluating Starbucks, I was aware of Starbucks. In fact, it's the growth stock feature in the June Better Investing magazine in my column, and so you can read a little bit more about it there. And I believe I even mentioned the history of Starbucks and that column that I've actually featured it about 9 years ago, sold it about 7 years ago, and am now buying back in it. So the tack that I took this month was to just take the default judgments on manifest and evaluate them as see whether they seem reasonable. And here's the first slide. Notice the excellent quality and the highlights on quality. Remember that a score of 12.5 is average, so you can see that in all four areas it's well above the average. And of course 25 is the max, and you see two are bumping up against the max. So Starbucks is both an overall high quality as well as the four sub areas. Next slide. Here's the consensus expectations on value. Again, I found them all to be relatively reasonable. The numbers that are out on the right-hand side, the sales growth forecast among consensus was 11.1. The 9.8 is the actual 10-year history, so they're projecting a little above the 10-year average. And in fact, if you look at the last 8 years, you're going to be in the 11 to 12 to 13% range, depending on exactly where you look. The 9.0, however, is the trailing 12 months. So Starbucks has had a couple of quarters down below that 11, 12% they've been running for the last 8 or 9 years. It does pull the trailing 12 months down to 9%. But again, for purposes of this analysis, I was comfortable with calling the sales growth with the sales growth consensus. Net profit margin, they are looking at margin expansion, and that is, of course, a major strategy that Starbucks is looking at right now, is expanding their margins by selling more of those very expensive drinks that Mark talked about, and also pushing some mobile sales and so forth. The trailing 12 months margin is 13.4%. So that's what that comparison is. Then the average PE ratio over the last, really it's my analysis over the last 10 years. I excluded the recession years and the one bad year that Starbucks had, and the historical 10-year average is 26. The current PE is about 29, and so the projected average for consensus is 24. Again, I found to be reasonable. All of that led to a projected annual return of 13.2%. At that time, it's about 11.9, I believe, today because of the price run-up using the same judgments. Next slide. This is just the chronicle on Starbucks. You can see that by historical standards, the quality has been pretty steady. Had a little bit of a dip from near perfect to slightly less than perfect, but it's bounced back up. But of course, of most interest on this particular slide is the relative return, or excuse me, the par line, and notice that it is near an all-time high based on this particular slide. Next slide. Doing a quick industry comparison, I always like to buy not just a good company, but the best of the available companies in the industry. This is ranked by par. You see that Starbucks gives you the second best reasonable expectation. I'd consider that 60 is probably a little questionable, but also notice even on Zoe's kitchen, while 16.5 is reasonable, notice the quality ranking. So obviously Starbucks is a good, for restaurant, very good par. Next slide. Looking at quality, again, it's right in the top of the industry and right in there with Popeyes and McDonald's on quality. So it fit my industry comparison test. And then next slide.
And by the way, folks, Popeyes and Panera have both been acquired in recent weeks.
I wasn't aware of Popeyes. I knew Panera had been.
Your last slide.
So that is my last slide. So that is my reasoning on why I suggested Starbucks as this month's add this month. And if you like drinking coffee, then please vote Starbucks when it comes to poll time.
Keep trying. All right.
We're going to have to get campaign signs pretty soon, guys. Okay.
Okay, a quick nod to Mr. McManus. He wishes he could have been here tonight, but he is traveling. I talked to him at the airport this afternoon. He did say that if he had been here, his selection would have been Bristol-Myers Squibb, and it's actually fairly closely related to some of what you're seeing on the screen here. Again, he likes to screen for very high quality, mostly core type companies for the part of his portfolio that he doesn't talk about at convention. He saves the speculative stuff to be flinging around in the audience. But in this case, as you look down the list, very high quality companies that happen to be trading fairly close to their 52-week lows, you find a number of companies in the sector he knows the most about, from Amgen to AbbVie to Biogen, those type of companies. And so that's probably that same type of theme where Bristol-Myers Squibb, in the mode of recovery, improving pipeline, buying pipeline where it doesn't have pipeline. And you can actually go back and listen to some of his remarks from a couple of months ago when he last selected Bristol-Myers Squibb. But some interesting companies on that list. FleetCor makes the list down at the bottom. You heard Qualcomm mentioned earlier tonight. Tractor Supply, with its price plummet that you saw on those previous slides, in the absence of any change or down deterioration in the fundamentals, Tractor Supply actually looks good if you believe that they're not facing a severe competitive threat. So with that, I'll just go ahead and share some of the companies that showed up. This is a little bit dated today, but most of these are good on what we refer to as our long and short, where we basically display a list of companies that have decent long-term expectations. Long-term is measured by the projected annual return. You can see most of those are probably in the buy zone, along with the outlook from Value Line is also a very long-term 3 to 5 year look, along with Morningstar and Standard & Poor's. They use a price to fair value for their long-term analysis. And again, fair value is what they think would be a decent price for the stock. So anytime it is less than 100 and not too low, it can be a fairly attractive situation. So you're looking for numbers down in usually in that 80% type range, suggesting that the company might be as much as 20% on sale. For example, Lulu down here at 80% from both S&P and Morningstar. They're suggesting that Lulu could be potentially on sale by as much as 20%, and that's what puts it in the buy zone on most stock selection guides. We also throw in some shorter term looks, the analyst consensus there, and on the right hand side, along with S&P and Goldman Sachs, just to give a look at what the rhinos, the institutional analysts, are looking at for the next year to come. Again, our theory there is that sometimes self-fulfilling prophecies can take shape, and if all of the institutional analysts following a company have high expectations over the next year, chances are they might give you some buying pressure or support. Going down this list, I'm going to pick one right near the middle, CVS Health, company that is no stranger to anybody here. It's been selected 6 times for the round table. Some very nice characteristics, buy zone type characteristics, along with fairly favorable outlooks from all of the companies involved, from Value Line to S&P and Morningstar. Really decent outlook, and along with a decent outlook for the year ahead. By the way, the average stock right now is running at about 9% for the total return forecast for the next year. So I only have one slide, and it's just that same old tried and true picture that Ken is most infamous for, that up, straight, and parallel. This is a well-managed company, from drugstores to pharmacy benefit management to just selling retail stuff on the shelves. They do a real nice job. They are regarded as one of the strongest pharmacy benefit management companies out there, although it's a very competitive field, no surprise there. And they go head-to-head with Walgreens in certain areas of business, but you can see that up, straight, and parallel certainly applies. As of the early part of March, the return forecast was in the mid-teens, and you can see that the price has continued to drop down from the low 80s down into the mid-70s since then. Some of that is a result of them losing a couple fairly major contracts that they were pursuing here over the last couple of years, and then some other stuff that I've been reading here over the last few days about the ultimate competitive threat from a company like Amazon. And a lot of that stuff is weighing on the company, but you're still looking at a mature, very well-managed company operating in that 8 to 9% growth type threshold. Take a look at their profitability over time. Again, this is a fairly competitive arena, and you can see that they've been chunking in pretty consistently up in that 3.6, 3.7, 3.8 net margin realm. And just as an example, or for context, Walgreens Boots Alliance and companies like Walmart check in fairly regularly at that 3.5% range for net margin. So you can see these guys are holding their own. You see some of the chagrin and consternation over the expectations for this year and next, and at least Value Line has them approaching that long-term trend line going forward. The PE ratio again does a little bit of a dance, but something in the mid-teens. It seems to make a lot of sense to going forward, especially as the company matures and continues to fire on all cylinders. I see a company that is well-established, well-managed, with a return forecast of approximately 15% based on tonight's close. So I'm going to go ahead and throw CVS on the pile one more time. So with that, Ken, I think we can go ahead and take the poll. We came in at about 9:30. That's where we like to be.
And if you give me just 1 second, here we go with launching this poll now. And folks, all you need to do is take your mouse and click on the stock that you'd like to add to the portfolio.
When do presenters get to vote?
What? You've already voted. You already have one position, Mark.
I voted?
Whether they like your stock or not, $1,000 of CVS Health went into the portfolio.
Oh, that's true. That's true.
All right.
That means I can coast.
You can coast.
Absolutely, absolutely. Sliding down.
We're down to about 85% of our audience voting. I'm going to give you just a few more seconds. If you're new, it doesn't cost you anything. Just pick a stock. It's for bragging rights more than anything else.
Well, one of these days
I'd love to stick us above 90 right here. If we could get 2 or 3 more of you to vote, we can go to 90%. I guess we're not going to get there this evening. We're at 89%. Going. Okay, I'm going to close the poll, and I'm going to share the results.
Wow, another tight race.
Yes, it certainly was. In fact, it's not very often that all 4 of our companies get a good representation of the votes. So we're going to add a Dollar General And Mark, we had almost a third of the people picking LGI. Do you want to put a second position in for LGI as well, or just stick with one?
I don't see any reason not to. Those are within the margin of error by any pollster.
So we'll add an extra $1,000 for Dollar General and an extra $1,000 for LGI Homes. Let me hide this right now. And we're ready to start dealing with questions. That if I can.
And while Ken's checking that, I'll just make the point that the Cincinnati Convention, again, thanks to all the volunteers, and we were honored to be guests at that, and the presentations and audiences were wonderful that we were able to witness. The June Roundtable will be last Tuesday in June, June 27th, same time, same bat channel. And again, we just wanted to issue the reminder, be on the lookout if you're in any of those areas. Cleveland and Pennsylvania were mentioned earlier, but we also have engagements for one or multiple combinations of us in Dallas, Denver, and we're going to be working on St. Louis in the near future also.
Mark, let's go back and take Joe Whitaker's question that came to us right at the beginning of the session tonight, okay? And he says, we've been talking about profitability forecasts, and you made a public apology to Value Line last month.
I did.
And you plan to start to redo the profitability calculation for every stock in the database. That was going to take a quarter, by the way, Joe, because it was going to be done issue by issue. It wasn't going to be the whole database in 2 days. But I know Mark is busy doing that. Mark, could we start the conversation by going back to that slide that I asked us to take a look at? I think it was for...
I got you.
Yeah. And I think this is the coach slide, and I wanted to draw your attention to profitability. And Mark, I wanted to ask you a question right in the same line as Joe. If we're starting to reevaluate this profitability, I know that one of the tenets you were using was that Value Line is tending to segment these growth areas into 3 different segments. Would you consider that there might actually be something different happening from 2015 outwards to their estimate in 2021? I see a definite upward trend from the low point up to their 3 to 5 year forecast, and I'm wondering if that would be reflected in the current evaluation that you were doing for Coach.
Yeah, and just in a nutshell, without getting too hairy about it, what Value Line does in these cases is they take a look at the situation, and it's usually at least this number of years, and what they're looking for is trends, and those trends could take a number of shapes, from the one that you see here, kind of a gentle slope down, to a plateau, to in some cases companies will actually have a bathtub type situation. As you look at the Value Line company reports and you're paging through them, they've got that thing they call the Value Line, THE Value Line, and you can see how the price to cash flow ratio is adjusted over time. And what they're doing is they look at something just like this characteristic, the profitability characteristic for the company, and they mathematically will segment it into, in this case, let's just say the math were to draw a couple of lines here and say there's three different life cycle periods here. One where the growth is slowing down and fits this line coming down here. Perhaps one where there's a little bit of a plateau in here. And then now they're watching this situation of a possible uptrend. That's how they get the number that they get. They take any company and basically use math to segment it into pieces like that, and then do the regression or the trend analysis on the different pieces. And that's the only way you can take a look at a picture like this, where it looks like we're looking at a number down in the 12 to 14 range here based on the trend, if you follow me, and come up with a different number of 18.5 up here. And that's what this number is right here. And so watching this over the 2,400 companies in the database, and we are probably about 75% done already, converting this company after company, we find that the value line analyst is actually coming up with a better situation in most cases. And better, by better, I mean what seems to be more representative. If you go to the Manifest Investing website or to expectingalpha.com, you can actually find the analysis on Church and Dwight. And for those that aren't familiar, you can drill in on that hourglass. And I want to use this to reinforce what we were just talking about. Under this thing called Profitability Lessons for Church and Dwight, here's a look at Church and Dwight over the years. You can see that's about as close to up, straight, and parallel as you're ever going to get. What I want to draw the audience's attention to, though, is this profitability graph. Over the last several years is definitely on an upswing, and it's a fairly steady upswing. Those of us in the community that have used the preferred procedure over the years and look at Section 2A, a lot of the time we form the input based on a trailing 5-year average. A trailing 5-year average. Well, the only time that really works is if this were flat. If this were actually flat here. Here's a look at all the companies in the U.S. market since 1940. It's anything but flat. And the problem with that is it doesn't work. And here's a closer look at Church and Dwight. What happens is if you've got a company with an uptrend like that, Coca-Cola fit this mold, there's a whole bunch of companies that fit this description over the years, and you use the trailing 5 years as your forecast in the preferred procedure, you end up with a consistently low actual versus forecast. And that's what you're looking at over here. The forecast here are in these purplish bars, and what actually happened is up here. And as our good friend Marty Eckerly pointed out a few months ago, that difference is just too big if you're talking about trying to generate a representative forecast. And if you flip it around now and you talk about a company that doesn't look like this but looks like the opposite, where it's maturing and coming down like many of the companies out there, what we actually do in those cases is overestimate based on the trailing track record in the same way that you see us underestimating on the right-hand side of this one. And that's why you saw a fairly gentle but a little bit material shift in Mesa Labs and Proto Labs because they are maturing. And again, keep in mind that any input that comes in, any quarterly result or annual result that comes in, deflects the trends. And it's going to be just fascinating to watch this going forward. But in a nutshell, if that's not flat, in the case of many companies, that actual net margin, as we saw for CVS, for example, is flat at 3.7. This all becomes kind of moot. But for the case of companies with changing, ramping either up or down profitability, we just have to take our hats off to the value line analysts and say they're probably doing a better job projecting that than we ever gave them credit for. Does that help?
Mark, we have a question from Joe, and he'd like you to just real briefly again tell him what a core holding is by the definition that we're using.
Yeah, the definition that we're using is a company with a track record, high quality, that has been through at least one, if not more than one, recession or bear market or even, deep correction. And we think that's a pretty good definition. If it's a high quality and it's actually been through, in the case of the one that Kim presented tonight, great looking company, but they have not been tested by a deep bear market yet. So it'd be interesting to see how the company is, responds when they are tested in the future. So that's kind of the way we saw core versus non-core.
Joe is asking us, if we believe in the BI methodology, why not double down on Mednax? And I'm going to take this question because I was the one that put Mednax into the portfolio in the first place. Joe, I think that the BI methodology teaches us to try to apply everything we know about a company as the company goes through quarter by quarter by quarter. I've been concerned with Mednax now for a couple of quarters, in that their biggest sub-business, which is dealing with neonatology, dealing with newborns, that business has been significantly impacted by a lower birth rate throughout the country. Now, Mednax is really scrambling by acquisition to add other types of physicians to its stable of physicians. They're doing a wonderful job in doing something called in doing a different type of radiology, where they're collecting groups of radiologists together in an electronic location and then pulling x-rays from all over the country and assigning them to a radiologist that has expertise in that field. That's different than the normal model of using the 3 or 4 or 5 radiologists that might be on staff in the hospital where you happen to be, and they just take the x-rays at random and try to read them and figure out what's happening. Mednax is doing a great job in increasing that business, but it's still a very small part of the business. The same thing's true with their anesthesiology practices that they're adding. Great job of growing that sub-business, but still not a major piece of the entire business. I think that that argument, along with the argument of loss of capital, gives me a good reason to step back from Mednax, and maybe, if I'm interested, keep an eye on it for the next 6 months or 9 months or 12 months. And if those other businesses that I mentioned, the radiology business, the anesthesiology business, if they continue to grow at this double-digit pace, and if the neonatology business levels out and maybe even grows slightly, I might be back in that company very quickly, maybe within 6 months or 9 months or 12 months. But I think I've preserved some capital by using these guidelines that we're trying to set up and test. Mark, we have a question from Gene. How long should it stay at a relative return of negative 20% before the judgment begins?
Well, our standing procedure is going to be at any point when it reaches that during our monthly meetings. So, I mean, that's when it kicks in. When it falls behind by 20%. You know, what's on the screen here, it's a little bit blurry, but that is the Iconics brand. This is kind of the answer for Joe. And there's a part 2 to the answer also. But Iconics brand had dropped down to 20% against a flat total stock market. And getting out at 800 would have prevented another plummet down to, I think the last time we checked it was at about $220. So, you know, averaging down into that would not have worked very well. And one of the things we're going to be looking at very carefully is any degradation of quality that goes along with this also. So if we see a degradation of quality in Mednax, along with the stuff that Ken was just talking about, that's even more fuel for the fire to not have any thought of doubling down. So you can actually...
Kim, we have a...
Go ahead, Ken.
Kim, we have a question from Susan for you. Is the drop in LGI's price due to the weak most recent quarter? Is that why the price is a little bit under pressure right now?
Probably so. I mean, they didn't have their sales are good and they have a lot of backlog, but their sales dropped a little bit and their earnings per share dropped a little bit. And this is a small company. It's under $1 billion. It's $750 million. So they're going to be a little bit more volatile. And anytime right now, I would expect this price to drop as we're going into June and when the Fed's going to announce if they're going to raise interest rates. Because I think this stock will be very sensitive against interest rates.
Kim, a follow-up question from Ken out of Pennsylvania. He says, is there any proof that millennials are buying into these LGI home communities?
I thought I read something. It's just they're specifically after first-time home owners. And it could be the senior citizens who are downsizing. Because then they could pick what they want in the house that they're getting. But it's usually millennials who are trying to get their first home. And the big thing is they don't have to have the down payment.
I will make a comment to that. If you look at some of the places they're building their communities, those are definitely the areas listed for as the most promising for fairly recent college graduates. I mean, almost every community on that map that Kim showed, with a couple of exceptions, nationwide.
Because they had it in their slide deck and a couple of the reports that I listened to. They're specifically trying to grow in locations across the U.S. where there is expected population growth.
Kim, one more follow-up. Jean would like to know if you've done any actual feet-on-the-ground investigation of LGI communities.
There's nothing in Indiana, and I'm in Fort Lauderdale, so the answer is no.
Okay, Mark, I'm pretty sure I know the answer to this, and I'm pretty sure maybe Don knows the answer also. But Don would like you to put a blank page in the manifest that pulls up the value line report as you do your stock study, so that it's all in one place. What do you think, Mark?
Well, the answer is we can't do that. We might be able to get permission for the Dow 30 because those are public. But we could only do that on a very limited basis for educational purposes because it's a product that they sell, and they would sue me into oblivion. Is that the answer you expected?
I think it's what I expect. I think it's probably what Don should have expected as well. We're getting
let's remind Don. Let's remind Don that I don't know if I've found a library yet that if you have a library card and you have internet access to the library, that you cannot get your value lines from a library for free. It cost me $2 every 3 years to get a library card from my library.
Kim, we're getting some validation from Ben, who says that his wife and he have visited LGI sites in Austin, and they were extremely impressed with the community. So there's an anecdote for you to add to your presentation. Len is indicating that Mednax has had some issues with operating expenses for a long time, and that they've growing. Len, I think you're absolutely right. This is a very acquisitive company, and there's been a lot of acquisition charges over the last 5 or 6 years. If you go back, I think you'll be, I don't know if it's pleasantly surprised, but you will be surprised by the number of acquisitions. In fact, that's the crux of Mednax's business model, is to grow by acquiring physician practices throughout the country. Ken would like to know, is Dollar General Amazon proof? Anybody want to take a stab at that?
I want to know if CVS is Amazon proof.
All right.
I guess my question is anything Amazon proof?
Paint.
I think of all the different kinds of retails that you're looking at, the dollar stores, in my estimation at least, and some of the deep discounters like perhaps Ross Stores or TJX, I think they have a better chance of being Amazon proof. I still think that you go to a Dollar General to pick up 8 or 10 items that you can get immediately and that are really common. I can't see them wanting to wait 24 hours to have them delivered, when the Dollar General model is to have a store less than 3 miles from where I reside. But I'm older than dirt, so I might just be phasing my whole thought processes into oblivion here. So, Ken, I don't know if I can answer your question. Marty says, concerning core, non-core, wouldn't your rule, shouldn't your, what are we reading here? Shouldn't your rule, wouldn't you want to add successfully survived a recession? Oh, okay. Marty says maybe we should have the word successfully in front of the word survived a recession, Mark. Not just survived, but successfully survived.
Well, if they unsuccessfully survived, isn't that they died?
Yeah, that's
Either that or they went into a coma, one of the two.
I mean, I think I kind of know what he's probably saying is that maybe they staggered through and are still around, but I think we probably wouldn't be looking at those companies. But.
Yeah, Marty, maybe what we should do is that they came out of a recession in fairly good
Well,
good fashion. Maybe that's what we're looking for,
I don't
you
know if
know?
you can see the screen right now, but Mednax, if you actually look at what happened during the 2008, they got hammered pretty good. And maybe, you know, we had looked a couple of years ago at gauging the depth of impact of the recession. I mean, this is a company that went from 36 to 11. That's pretty severe. I mean, that would, in my book, that might be a threat to considering them a core company. And maybe
Mark,
way.
I'm sorry, go on.
I'm
Mark, can you help Linda, Mark, by going back to the beginning of the presentation and showing that URL where she can take a look at the entire roundtable portfolio?
Sure. Anyhow, I think that actually maybe placing a metric on how the company handled a recession could also be part of that question. I don't know. We want to keep it simple. Also.
Yeah, and this kind of debate really helps us crystallize where we think we might be headed, and I don't see us reaching a consensus on this whole idea in 2 weeks' time. I think this is still a long-term project, and just the fact that we're talking about something like this, I think, makes us think about what's important and what's not important. So even if we decide this doesn't take us anywhere, it still made us think about a lot of the things that go into evaluating a company and trying to keep tabs on a company.
And I do want to leave the audience with this notion of we think, based on what we have seen, that there's the potential for climbing a couple of positions up this chart. In other words, improving your performance by a couple of percentage points, which is just huge. And again, this is anecdotal and preliminary, but that sort of thing. And the other thing I wanted to make the point, if you're not a Manifest Investing subscriber, you can go to expectingalpha.com. And I've never seen that page before.
There's a first time for everything.
Huh, that's weird. Anyhow, expectingalpha.com on a computer that's cooperating. Wow. I've got some work to do, I guess. Well, actually has that article on relatively better selling, and it also has that article on Church and Dwight and the profitability stuff that we were talking about when we started the Q&A.
Well, Mark, could you go back if we're through with the questions, and I think we're pretty close.
I have one question left, and then we'll do what Cy wants to do here. Phil is asking us about Qualcomm, and we've made the point, albeit we didn't plan on making the point, but we noticed that Qualcomm is significantly underperforming when it sits in the top right here. Phil, I think that we can promise you that we'll take a real serious look at Qualcomm for the next round table. Is that fair, Mark?
I think so. It's near the top.
Okay, and then Cy, go on with what you wanted to.
Since we had a question on the core, non-core, and virtually every time it comes up, there are questions about it, and I think even the four of us may have slightly different takes on it. I think in our gut, we think we understand it. Could you go back to the Mednax chart? I just want to talk about this successfully survive a recession.
You talking about the value line chart?
Yes, the value line where you showed the recession. I would contend, and this has, I'm not advocating for Mednax to be a core company. I probably would call Mednax non-core myself, but I would not do it by looking at the recession problem. And here's my take on what surviving or successfully surviving a recession means. The stock price got absolutely hammered. You're correct. But to me, the recession test is how did the business do? Take a look at cash flow per share, earnings per share, and sales per share. They're all straight up. The business survived the recession with flying colors. In fact, the business didn't see a recession.
Great point.
Yeah.
I mean, the stock price got hammered, but that's a bear market issue. And to me, recessions and bear markets are not the same, although they frequently happen at the
Happen
same
together.
time.
Yeah.
Right, but they're
I'm-
two totally different things.
I'm wondering if we're also, if you really are looking at price, maybe one of the things Marty was talking about also was that you'd like to see the letter V coming down to the depth of the recession and then coming right back out of it, roughly the same, at the same pace that it fell in. That's what I'm liking to see from a company where the business stays, and that's a really good way to phrase it, Si, that the business didn't suffer. And I love the fact that this company came right back out. Its price came right back out of that low price in about the same manner as it fell into that low price.
Right.
It was a very quick recovery for this pretty strong business. I've struggled with this core non-core as far as Mednax is concerned. Mark and I were talking even before the session this evening about and my feeling was that I had a much more difficult time calling a company core when its business model was based almost entirely on acquisition. That was a much shakier business model for me to wrap my arms around than a business that had a lot of organic growth going on in it.
Yeah. And I think that's probably where I don't think I could articulate it as well as you just did, Ken, but I think that's kind of my gut concern with it as well.
Si, I think you can rest your case on that picture right there.
Yes.
Yeah, this is textbook for what I'm talking to beginners, and and one of the first tests that I like to see is that the recession is invisible or practically invisible. When you're looking for companies that fit the model, and this company does fit the model, but this company's had some challenges recently, and I will say that I haven't sold mine, and I'm probably not going to. So. Even as much as I've talked to you about doing it in this portfolio, Mark. Okay.
Right. Well, I'll tell you, every time I look at this company, I think back to Orthodontic Centers of America, which had a similar business model, and many of the people around here remember that one now fondly.
It was good until it wasn't.
That's right.
We're about out of time, and I realize that. But one thing that I discovered for those of you who didn't go to BINC, didn't have the opportunity to go, BINC, apparently the word of the year was sell. Ken and Mark did a selling class. I did 2 selling classes, and there were several other selling classes. And this is purely anecdotal, but I evaluated in my selling class the selling decisions that I'd made in the growth stock outlook. And I compared what happened after the decision to both the market and to the replacement stocks, because that I do run that portfolio as managed. And what I discovered, and I did not realize this, in fact, I probably my gut would have been the opposite, but it shows how sometimes we need to look at stats even on our own stuff. I did a better job, and I think I was basically applying the traditional valuation and so forth methodology, actually did a better job selling on valuation than selling on quality. Mm-hmm. I mean, I flat missed the Starbucks recovery. Now, Starbucks was probably an exception, but there were a few others that the company, Landauer, which I think we sold out of the Roundtable portfolio. I took that out on quality grounds, and Landauer has recovered significantly. The one thing, and like I said, the sample size is way too small to be any sort of objective analysis, but my question comes, are we, because of our super emphasis on quality, even the companies that we pick that have dips in quality, are they still really better than the market and management ends up recovering and doing well?
It's a great point.
Could I compliment what you're saying by saying maybe we're making too much of a deal in a 10 or 12 point quality difference when we really should be making a big deal when the quality differences become 30 or 40 or 50 points.
I think so. I think so.
Yeah, and we certainly saw that with quality systems.
Yep.
So
I would agree because I know there's a few stocks in my portfolio that the quality dipped, and I read what the management's plans was of what they planned on doing in the future, and I had like TSS and how their management culture of the company itself, they had turned around before when they had challenges because they had good management, and I just stuck with it, and it did fine.
good stuff.
Yeah, really interesting, really good stuff, Cy. Really good stuff. Yeah. So I have cleared the question table, and we've chatted a little bit more, and nothing else has appeared. So Kim, I'd like to put a big special thank you to filling in for Hugh tonight. We really appreciate that. And as usual, Cy and Mark, thank you so much for your expertise and your discussion and everything else. And folks, we'll see you in the last Tuesday in June at the roundtable, and we wish you better investing, all of you. Good night, everybody.
Thanks and good night.
Bye.